Hi, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze this quite famous company called Moody's Corporation with the stock ticker MCO. And as always, we are going to analyze it using this little Canva presentation that I have right now here. So let's begin. First of all, why should you even listen to me? So as you know, my name is Yasha and I help young men invest in the stock market so that they can actually make some money as well, okay? Now, when you have more trust for me, click the first link in the description and I will teach you everything about it. Now, let's begin with the actual analysis. So this is going to be very simple, beginner friendly, straightforward. If you are a beginner, grab a piece of paper, grab a piece of pen, grab a pen, write some notes down because you will learn a lot, okay? Now, generally, whenever you analyze stocks as a complete beginner, you should care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value, and price. Now, here you have some quick facts about Moody's. So it's a capital markets company that was founded around 120 years ago, so in 1900, and they are working with risk assessments. Now here is immediately the first thing that you should pay attention to. Take a look where it was founded. It was founded in 1900, okay? Now, whenever you analyze stocks and whenever you want to invest in the stock market, okay, you should always take a look when the company was founded, because as a rule of thumb, the older the company is, the better chances they have for survival in the future as well, okay? Because, for example, let's take a look at Moody's, okay? It was founded 124 years ago. That means that it survived at least 5 major crises. It survived the Great Depression, it survived the Black Friday, it survived the dot-com bubble, it survived 2008 real estate crash, it survived coronavirus, and maybe also those Ukrainian wars and Palestinian wars and all of that things, okay? So you can see it survived at least 5 major events when stock market crashed, okay? And it's still here. Whenever you have maybe some startup company that was founded 2 years ago or something, there is higher chance that they will not survive the crash because they don't have the money, they are not established company yet, they are not famous, so there is higher chance that they will crash, okay? Now, whenever you have stocks, try to buy stocks or at least try to buy companies that were founded in 1950 or 1960 at the highest, because that will give us a bit more safety, you know, that the company is okay and they have higher chances of survival, okay? You know what I mean? So this is the first thing that you should pay attention to. And now we come to the chart. And for chart, we have an instruction that it has to grow for all 10 years. Now, what exactly does that mean? That means that I will draw a little exponentially growing line, kinda like that. And now we are going to compare the actual stock price with this black line, okay? So we are going to compare the stock price, which is this orange line, with the black line. And preferably, they should follow each other, okay? Now, what do we have here? Here we can see that the stock price is actually following this black line quite well. That tells us that the company is growing, that the price is growing, that they are more and more profitable, which is of course amazing for us because we want to invest in companies that are growing, that are profitable, that are expanding the business, and that they will just make us money at some point, you know, it's that simple. Okay, now let's come to the profit. And for profit, we have an instruction that it has to be in plus and it has to grow, okay? Now, here is the very same story. I will draw a little exponential line, kinda like that. And now we are going to compare the profit chart with this line, okay? Don't be confused. Net income and profit is exactly the same thing. Now, does the profit grow? Generally, yes. Look. It was growing quite well until 2021. But then since 2022, the profits fell almost by half, let's say. And now they are still growing slowly, okay? So probably because of Ukrainian war, the profit fell off a bit, you know, but it's still growing. So this is kind of a tough situation where you have to decide, yeah, would you like to based on that, sell or buy the company. And whenever we analyze stocks, we want to be as harsh as possible, okay? So just in case, we will mark profit as a sell, okay? Because of this little fall right now here, okay? Similar thing also happened in 2016. So we don't want to have any inconsistencies. We don't want to have any, I don't know, profits that will surprise us, you know what I mean? Because we want to invest in reliable companies. It's that simple, okay? And now we come to the debt, and preferably debt should be low and also decrease through the years. And what do we have here? Here we have exactly the opposite. As you can see, debt is growing. So that's also another bad thing to see, because obviously the more debt you have, the harder it is to repay it back. The more debt you have, the more profit you need to make to repay that debt. It's just chaotic in the long term, okay? Obviously, think about yourself. If you have a shit ton of debt, is that okay for you? Is that okay for your mental health? Is that okay for your well-being? Is that okay for your finances? Of course not. And the same thing is with companies. Whenever they have high debt, it's generally bad for them, okay? Because it just puts additional stress. You need to make more money to repay it, and you are just kind of always in that circle, you know what I mean? So here, growing debt is a no-go for us. Now let's come to the money, and with the money we literally mean the money that they have on their bank account, as you can see right now here, okay? And preferably they should have more money than the costs. Now, how do we know if they have more money than the costs? You are a smart young man, use your brain. Look, they have plus $2 billion on their bank account. So that obviously means that they have more money than the costs, because their bank account balance, whenever you have money, you have bank account balance, okay? That's how it's called. So their bank account balance is positive. They have $2 billion, okay? Why is this important? Because whenever something unexpected happens, they have $2 billion to pay for that unexpected event, okay? For example, let's say that tomorrow it's Tuesday, and one of their offices will be flooded by water, okay? Toilet broke and the water is everywhere. Now they have $2 billion to repay that cost immediately, you know what I mean? They will call the plumbing company, they will fix the toilet, and then continue with the business. That's why they have, when you have positive bank account balance, it's much easier to, you know, to solve some unexpected issues, some unexpected events, problems, you know what I mean? It's the same with you. If you have maybe positive, if you have right now $200 on your bank account, you will sleep much easier instead of if you would have maybe 10 euros, or you would go to a date much easier because you know that you have potentially 200 euros to spend, you know what I mean? So here with them it's the same thing. It's the same thing, bro. Now we come to the value, and obviously we want to invest in stocks that are undervalued, okay? Now, oops, sorry, I underlined that a bit weird. So we want to invest in stocks that are undervalued. Now, how do we measure valuation? We measure valuation by two little things. First thing is called P/E ratio, and the second one is called intrinsic value, okay? Now, I know that this might sound a bit complicated for you because you are a beginner on the stock market, but listen to me. P/E ratio should always be lower than 15, and intrinsic value should always be higher than the current stock price. Now, where do you find the P/E ratio and intrinsic value? On internet. You write Moody's Corporation P/E ratio and intrinsic value to the Google, and you find the results for this, okay? It's that simple. Now let's take a look. P/E ratio of Moody's was, at the time of making this video, almost 50, okay? Which is around 2.5 or maybe 1.5 higher than it should have been, okay? So in terms of P/E ratio, the stock is overvalued, okay? Now, P/E ratio, just a quick fact, P/E ratio is used as a metric to compare the stocks in the same niche, okay? For example, Moody's Corporation is working in capital markets. Now, we use P/E ratio to compare the valuation of Moody's with other companies in the same branch. You know what I mean? So for example, there is maybe BlackRock or I don't know, some other companies that are in the same niche as Moody's, and we compare P/E ratios between them so that we can see if the stock is overvalued or undervalued. Now, historically, the SP 500, which is that famous index, whatever, from America, historically it has P/E ratio of 15, and we want to invest in stocks that are under the value of SP 500. You know what I mean? That are undervalued because they have higher potential to grow. So that's why we have 15 right now here. Now let's go to intrinsic value. Okay, this concept sounds complicated, but its reality is actually very simple. Okay, intrinsic value tells you the price that the company should have based on some calculations from income statement, balance sheet, and cash flow statement. Okay, the fair price of Moody's should be around $300. Okay, but the actual stock price is 450, let's say. So the actual stock price is by $150 higher than it should have been. Okay, you know what I mean? Intrinsic value basically tells you what price should the stock have, but the current price tells you the current price. Okay, so whenever we have higher intrinsic value than the current stock price, we have undervalued stock. But in this case, the price is higher than it should have been, so the company is also overvalued in terms of that. Okay, you know what I mean? Intrinsic value tells you what they should have, and price tells you what they actually have. You know what I mean? It's that simple. Now let's come to the price, and for price we want to invest in stocks that are priced lower than 150 euros. For you, you are from America, so for you it's $150. Now the current stock price is around $445, which is way higher than 150. It's 3 times higher than what we want to see. So no, the price is overpriced as hell. Okay, now $150 is kind of the border that I decided for myself between overpriced or underpriced stock, because when you are a young man on tight budget and you are starting to invest in the stock market, if you buy this stock for let's say that you have a budget of 500 euros, right? And you want to invest in this company, you can buy only one stock and then you have 50 euros left. You know what I mean? So you don't spread your investments as good as you could, you know? So that's why if you buy, let's say, 3 or 4 stocks that are maybe 100 euros each, then you divide, you know, your portfolio a bit, you diversify it a bit, which is just overall better for you. Okay, so whenever you have stocks, try to not pay more than 150 per share. Okay, and now we come to the final evaluation, where we are just going to summarize everything that we found out about the company so far. Now, does the chart grow? Yes, it does. If you don't believe me, go a few minutes back and watch the whole video again. Now, does the profit also grow? Yes, but since the last 2 years, not that much. So we will mark this just in case as a sell as well. Does the debt decrease? No, it does not. Do they have money on the bank account? Yes, they have $2 billion. Is the stock undervalued? No, it's not. And is the stock price below 150? No, it's not. So should you sell and buy? No, in my opinion, you should sell the stock, because if I would be you, I would take a look at more in-depth research that I did right now here, and you can immediately see total equity. Okay, total equity means all of the money that the company gets into the company. Okay, and look here, for the last 4 years here, from 2014 to 17, they have negative total equity. That means that they had more debt than they had money coming in. You know what I mean? And this is completely unsustainable business model. If something like that happens, your company is fucked. Because let's say that you are bust, that you are broke, you know, how are you going to repay the shareholders back if you have more costs than money coming in? You know what I mean? So since that day, then they started to be more and more profitable, but still, whenever they have minus or whenever they have loss in the last 10 years, that's immediately a no-go for me. Honestly, I don't want to see that. I don't want to see companies in minus. So for me, that's a no-go for sure, you know. Additionally, the stock is overvalued, it's overpriced. So for me personally, I don't see something quite special about this company. I don't have that feeling that, yeah, this is the company that I want to invest in, especially because of negative total equity, which means that they had less money coming in than they had the costs. So for me, that's immediately a no-go. I don't want to be involved in a business that is not profitable, especially if it's already 120 years old. So for me, that's a no-go, you know, that's a sell for me, in my opinion. Now, if you want to know more about stock market investing, click the first link. I will be honored to teach you everything about it. Join me on my journey, click subscribe, let's become millionaires together, do the hard work, and see you on top of the world.